Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, welcome back to our group. With me, Anissa Bujanti, and my partner, Eva Sarimanalu, in Financial Statement Analysis class of Group 1. Okay, in this time, we will tell about the accuracy of understanding about the cash flows analysis. Okay, the first is statement of cash flows. First of all, we have to know what is cash means. Cash is an instrument that is always recorded in a company's financial statements. In the application of accounting, cash is a tool used to make payment for business obligation such as payables, tax, or etc. In the definition of cash, cash is a company assets in the form of cash, such as banknotes, coin, money orders, check, etc., which are owned by or stored by the company in a bank and can be used for general company activities. And what is cash flows? Cash flows is a financial report that contains information about the effect of cash from the operating activities, investment transaction, and financing or financing transaction that experience a net increase or decrease in a company's cash during a certain period. Or can set inflows and the outflows of the cash in the company. Okay, the next is relevance of cash. The statement of cash flows is key to the reconstruction of many transactions in the company, which is an important part of the analysis. Analysis of the statement of cash flows requires our understanding of the accounting measures underlying its preparation and presentation. This statement is important to analysis and provides information to help user address questions such as this, such as how much cash is generated from or used in operations, what expenditures are made with cash from operations, how are dividends paid when confronting an operating loss, what is the source of cash for debt payments, how is the increase in investment finance, what is the source of cash for new plant assets, why is cash lower when income increase, and what is the use of cash received from the new financing. Okay, this use the cash flow statement. The cash flow statement is intended to, the first is provide information on a firm's liquidity and solvency, whereas the liquidity is about an asset property of being able to be sold without affecting its value, and the degree to which it can be easily converted into the cash. And while solvency is the state of having enough funds or liquid asset to pay all of one's debts, the state of being solvent. And the second is improve the comparability of different firms' operating performance. And the third is to indicate the amount, timing, and probability of future cash flows and test for management decision. Okay, this reporting by activities of statement of cash flows. The first is the operating activities. That are the earning-related activities of a company and the principal revenue-producing activities of the enterprise and the other activities that are not related to investing or financing activities. The example of operating activities is about the cash received from the sale of goods and services, and then cash received from royalties, fees, and commission, etc. And then cash payments to supplier of goods. And then the next is cash payments to and on behalf of employees for the wages. The net effect of the operating activities on the flow of cash is reported as cash flow or cash used in the operating activities in the cash flow statement. The second is investing activities. Investing activities are means of acquiring and disposing of non-cash assets. Investing activities are the acquisition and disposal of the long-term assets and other investment not included in cash equivalents. These activities include transactions involving purchase and sale of the long-term productive asset. The example of investing activities such as cash payment to acquire fixed asset. Second is cash received from disposal of the fixed asset, and then cash payment to purchase shares, warrants, and debt instrument. And then is cash received from sale of shares, warrant, or debt instrument, and then cash received from future forward option and swap contract. And the third activities is about financing activities. Financing activities are means of contributing, withdrawing, and servicing funds to support business activities. Financing activities are the activities which result in the changes in the size and the composition of the owner's capital and borrowings of the enterprise from other resources. The example of financing activities is cash proceeds from the issue of the shares or other instruments, and then buyback of shares, and then cash proceeds from the issue of debentures and the other short-term borrowings, and the payment for interest on debentures on loan, and then payment of dividend, both equity shares and the preference dividend. The next is constructing the statement of cash flows. To construct the statement of cash flow, there is two methods. The first method is direct method. The cash flow direct methods determine changes in cash receipt and payment, which are reported in the cash flow from the operation section. And then the second is indirect method. The indirect method takes the net income generated in a period and adds or subtracts changes in the asset and liability accounts to determine the implied cash flows. And then the second material from me is about analysis implication of cash flows. There are some limitations of cash flow statement. The first is non-cash transactions are ignored from the cash flow statement and then not a substitute for an income statement, and the third is historical in nature. Furthermore, limitation, we will tell about this practice doesn't require separate disclosure of cash flow pertain to either extraordinary item or discontinued operation. And then about interest and dividends received and interest paid are classified as operating cash flows. And then money users consider interest paid in financing outflow and interest and dividends received as cash inflows from investing activities. And then income taxes are classified as operating cash flows. And then interpreting cash flows and the net income. Net income is carried over from the income statement and is the first item of the cash flow statement. Net cash flows from operating activities is calculated as the sum of net income, adjustments for non-cash expense, and changes in working capital. Okay, we will see the example or the form of statement of cash flow in direct and indirect method. Okay, this is the example of cash flow statement in direct method or direct approach. This shows that the cash outflows is included in the cash flow from operating activities, while in the indirect method, the cash outflows is not included in the cash flow from operating activities. Okay, you can see clearly this example to make sure we understand about the difference between direct method and indirect method of cash flow statement. Okay, that's all from me. We'll be continue with my partner Eva Sarimanalu. Thank you.
Analysis of cash flow. Since conditions vary from company to company, it's difficult to formulate a standard analysis of cash flow. Nevertheless, certain commonalities exist. Analysis must establish the major past sources of cash and their use. In estimating trends, it's useful to total the major sources and uses of cash over period of few years, since annual or quarterly reporting periods are often too short for meaningful inferences. For example, financing of major projects often spend several years in evaluating sources and uses of cash. The analyst should focus on questions like this. Are asset replacement financed from internal or external funds? What are the financing sources of expansion and business acquisition? Is the company depend on external financing? What are the company's investing demand and opportunities? What are the requirements and types of financing? Are managerial policies such as dividends highly sensitive to cash flow? Inferences from analysis of cash flow. An overall analysis of financial statement then either corroborates or refutes the inferences from the analysis of cash flow. There are useful generalizations we can make out about potential inferences from analysis of the statement of cash flows. Analysis of the statement of cash flow enables us to appraise the quality of management's decision over time and their impact on the company's result of operation and financial position. When analysis covers a long time period, it can yield insight to management's success in responding to changing business conditions and their ability to seize opportunities and overcome adversities. Inferences also pertain to disposition of earning and the investment of discretionary cash flow. Analysis also enables us to infer the size, composition, pattern, and stability of the operating cash flow. Alternative cash flow measures. Users sometimes compute net income plus depreciation and amortization as a crude proxy for operating cash flow. One variant of this measure is the popular EBITDA, earning before interest, taxes, depreciation, and amortization. This measure suffers from several problems. First, the add-back of depreciation is sometimes interpreted to mean that the expense is not legitimate. That is incorrect. The using up of long-term depreciable asset is the real expense that must not be ignored. Some interpret the depreciation add-back to indicate that cash has been provided for the replenishment of long-term asset. That is also incorrect. The add-back of depreciation expense does not generate cash. Net income plus depreciation ignore changes in the working capital account that comprise the remainder of net cash flow from operating activities. Free cash flow. A useful analytical derivative of statement of cash flow is computation of free cash flow. As with other analytical measure, we must pay attention to component of computation. Ulterior motives in reporting the component used in computing free cash flow can sometimes affect its usefulness. Cash flow as validators. The statement of cash flow is useful for prediction of operating result in the basis of acquired and planned productive capacity. It also of use in assessment of company future expansion, its capital requirement, and its sources of cash inflow. And the statement of cash flow provide us with important clues visible of financing capital expenditure, cash sources in financing expenses, dependence on external financings, liability versus equity, and future dividend policies, ability in meeting debt service requirement, financial flexibility to anticipated needs and opportunities, and financial practice of management, quality of earning. And specialized cash flow ratio, cash flow adequacy ratio. The cash flow adequacy ratio is measure of a company's ability to generate sufficient cash flow from operation to cover capital expenditure, investment in inventories, and cash dividend. To remove the cyclical and other random influence, a 3-year total is a typical use in computing this ratio. The cash flow adequacy ratio is calculated as follows: 3-year sum of cash from operation and then divided 3-year sum of capital expenditure, inventory addition, and cash dividends. And cash reinvestment ratio. The cash reinvestment ratio is measure of the percentage of investment in assets representing operating cash retained and reinvested in company for both replacing asset and growth in operation. The ratio is computed as operating cash flow minus dividends and then divided by gross plan plus investment plus other assets plus working capital. So that's all of the video. Thank you for watching and see you in the next video. Bye.